And it's great to see you. And is this because of something, does it go back to the Fed meeting that you think everything started to change?
Well, I think emphasis should be on easing, and I purposely didn't use a word like ending. So I think that even before the Fed meeting, you had the bond market signaling that inflation risk maybe was more in keeping with what the Fed has felt, given that after the spike to 1.7 and change back in March, you saw an easing of those yields. And I think that the spike was in anticipation of what we're seeing now with inflation. I think some of the short-term effects, not least being the base effects, are just mathematically easing because as we look at the June data, that goes up against last year. June was the first month we saw an uptick in inflation metrics. I think the key medium to longer term is the stickiness of wage pressures, whether it's a one-time reset, whether some of these price shocks are a one-time reset, or if it becomes that psychological spiral that ended up causing major problems in the 70s. I think for now, those conditions are not in place. We have strong productivity, but those are the factors to look for beyond the near term.
Are you so let's talk a little bit more about the fall in yields from the 170s down to the 144 area. If I'm hearing you correctly, I'm hearing you say that the bond market is not so worried about persistent inflation. Often lower yields suggest that the bond market may be worried about slowing economic growth or some other threat. And that's why the yields would go down, not up. Explain.
Well, also, it's maybe perverse when you have a Fed that either makes a more hawkish set of comments, or in the case of the most recent Fed meeting, you had the change in the dots plot. Much like periods of QE and when the Fed wasn't in QE, yields actually moved in the opposite direction of what conventional wisdom would suggest. And that's just the telegraphing nature of what the Fed does and how it forces maybe a change in expectations. So I think a shift to a more hawkish stance via the dots plot actually suggested that the Fed would be stepping in maybe sooner than it anticipated, which quells some of those longer term inflation concerns. And I think that's to some degree what's been in play. And I just think certainly in this environment, the bond market generally is a bit more rational in the message it sends about the economy and things like inflation than maybe the stock market is.
So let's round third and bring it home to the viewer. What should I do with my money given what you just described?
Well, interestingly, when you do have inflation pressures, near term or even ones that are a bit more longer lasting, as we saw when we had the yield spike in anticipation of this upward move in inflation, you tend to see a bit more pain in longer duration assets. Now, with the calming in the yield, you've seen a move back into some of the growthier parts of the market. That said, even within those growthier segments of the market, be it tech or consumer discretionary communication services, stocks that screen well on value factors, whether it's free cash flow yield or book yield, have been doing better within those sectors than those that screen well on the classic growth factor. So this whole value versus growth needs to be thought of in a different way, because from a factor perspective, value is outperforming growth more in the growthier sectors. So what we've been telling investors is don't put blinders on to either the indexes of growth or value or thinking about what sectors those represent. You can actually look for companies, look for stocks that screen well on value factors, but not give up that growth opportunity. And I think that hybrid approach, especially in this environment that I think favors active stock picking, is better than taking a kind of a blinders on passive approach, either at the index level or the sector level.
Shepard Smith here. Thanks for watching CNBC on YouTube.